Right now, focus on Metro Brands and Nissan Joseph with us, the CEO of Metro Brands. Mr. Joseph, great speaking with you again, and as always, pleasure to have you on NDTV Profit. Let's quickly go through your Q3 numbers, and what strikes me is EBITDA margins have stayed in the same range, but net profits are slightly muted. Overall, healthy bump up in revenues as well. How would you look at the key highlights of the third quarter?
Sure. Good morning, and thanks for having me. I think let's take it one at a time. I think from a revenue standpoint, we were very pleased to see that we're back to a double-digit growth again, which was in line with our expectations. We had a challenging Q2 and Q1, largely because of the shift of wedding dates. This quarter, we were pretty much in line with last year, and we can see that in the results coming in as expected. So that's number one. Our EBITDA had a considerable improvement. So we were up 10% in sales, but we were up 13% in EBITDA. From a PBT standpoint, profit before tax standpoint, we were actually up to 18%. So it's the tax plays into it as we've reconciled and reassessed some of the tax assessments from our Fila acquisition. But if you look at the profit before tax, it was a healthy 23%, which was 18% up over last year. So overall, I think it reflects well for where the economy is headed in terms of demand. It also bodes well as we show the operational capabilities and the efficiencies that Metro brings.
But if I look at your 9-month EBITDA margins, there has been a bit of a tapering. What is the kind of guidance you're looking at for the full financial year then coming off? Because I would assume that this is traditionally a good quarter as well.
Right. We've traditionally guided that our EBITDA range would be right at the 30% mark, plus minus 1 or 2, right? So, and I think we want to continue to maintain that, and we feel confident that, that's something we've guided to for a long time, and that's something we feel confident that we can continue to achieve over a period of time, not only just one more quarter for this fiscal year.
Okay. What about the revenue per square foot? Again, I'm looking at this, and hi, Alex joining in. But I'm looking at the 9-month numbers here as well, and there's been a bit of a reduction there. Is there a reason why that has taken place?
Yeah, I think there's a couple of reasons for that. So first of all, I think if you looked at the preceding 2 quarters, our revenue per square foot delta compared to last year has been closing. So I think we were off by 50 rupees per square foot in this recent quarter. The good news is it was considerably more in the previous quarters, alluding to the demand that was with the festive season that I talked about, right? So that's number one. But as we open new stores, we are opening them in areas, in markets that aren't the juiciest of markets, because let's hope we've already got to the juicy markets, right? So you have a high velocity of stores that exist in very high-performing markets. And as you expand, whether it's a tier 2 or even a secondary market in a major city, it's not going to have the same productivity. So that's number 2. And the third reason is that, it just depends on the mix of stores you open. Our Crocs stores, as you know, tend to be 600 square foot and very high productivity from a per square foot standpoint. Whereas our Walkway stores, which is more of a value chain store, may not be quite as much productivity, though the units would be far more than what we sell per square foot in a Crocs. It doesn't flow through to the rupees. So you got to look at these factors that appears that there's we're not growing our sales per square foot, but really is a mix and a combination of these 3 reasons I mentioned, Alex.
Okay. Speaking about that mix, talk to us about the new additions that you've had to that mix, right? You've got new kiosks that you've started in the new Era brand, and you've also got new Footlocker stores. What has the response been there?
Yeah, I think the 3 things we're quite excited about right now is one is our continued, repositioning of Fila, right? So we've come out of the quarter and we've liquidated through all the old goods of Fila. So we feel good about what that's been. And now we can focus on repositioning the brand as we always said we would do this fiscal year. We've started dropping Fila into our Metro Mochi stores, and we'll continue to do those drops. And it takes a while to build a brand. It's not an overnight story. So that path has begun. So that's very exciting. The second exciting news is, as we opened our first Footlocker store in Select City Mall, and that's doing quite well. It did have some challenges because of BIS. There was some limited supply. The good news is we're starting to see the air and the fog clear up on BIS. So at least we'll have a clear idea of the runway we have for BIS and what that means to the Footlocker business. And last but not least, I think New Era is a great addition. It sells in our Footlocker stores, and of course, it also has its own kiosk, because I think it attracts a whole new genre of customers, fashion forward, youth culture, and that's where I think also our growth will come from, not to mention Metro Mochi.
That's great. Just a couple of things I wanted to ask you, Mr. Joseph. One is that your online segment, your e-commerce segment, is it on track to what you had hoped for? You have a 10% improvement right now. Do you see that bumping up? And what's the sort of mix that you see down the line?
Yeah, so the e-commerce business is about 11% of our business today. And that's a number we're quite comfortable with, because as you know, in India, that number can be driven up or down vastly depending on what your appetite is for discounts, right? And we don't believe in discounting. We don't think it's accretive to the brand when you discount those kind of products. So it really is a maintained number. And one that we hold a tight control over, because we know we can step on the pedal of discounts, and those sales could go through the roof. But that's not the objective of how we want to grow our business. Looking to the future, I think e-commerce is going to continue its growth trajectory. It's not going to come at the cost of brick and mortar is not going to take away from the e-commerce growth. I also think when you have added levers of, let's just call it quicker commerce, think about what's happened in e-commerce deliveries. It's gone from weeks to days to hours to minutes, right? So we think that also opens up some opportunities for us in that space. So it's an evolving space, but you can rest assured that we'll continue to monitor it and test it and ensure that we also capitalize on any potential there.
Just want to get your sense, Mr. Joseph, on demand, because okay, Q3 is traditionally good, and you've said that in your con call highlights as well. Festive season, wedding season, etc., has boosted you. What is Q4 looking like in terms of an outlook overall? That this demand question mark is out there. I'm wondering what you're seeing, especially now that you have a presence outside top cities as well.
Yeah. So actually, we're continuing to see that run its course, because what we think happened, what we know happened in the previous quarters was the lack of wedding dates, and the disproportionate amount of wedding dates the previous year versus a very few, if not zero wedding dates this year. That normalized in Q3. And when we look at the Q4 calendar of wedding dates and festivals and so on and so forth, they all are in line. We've just been through Pongal recently, and the consumer demand is behaving the way it should. So I believe that the normalization that has come after the 2 phenomenal years after COVID that we had is starting to level out a bit, and that's going to be back to good old retail.